Whether we're going to have a boom or bust, protecting your wealth during a recession is one of the keys to actually continuously build wealth and get to financial freedom faster. Why is that? Game is that whoever has the most amount of assets hold on to the most amount of cash by the end of this run, where we've got high interest rate, instability, world wars, everything else, until we have a flattening of our consumer price index and until we actually have our first and consecutive rate cut. The race is not over. If you're currently already struggling, you need to listen to this video, because I'm going to share with you what you need to keep, the type of asset you need to invest in, and how to hold on to it so that you benefit more in the future when this recession is over. Now let's have a look. Now I'm looking at an article here on a rally executive. Now the title of this says, "Will Australia go into a recession in 2024?" Now, it's an article that was written on the 16th of August in 2024, and it basically dissects what exactly are the triggers that make us go into recession. Now, how do we count for recession is when we have 2 consecutive quarters when we're going backwards in our gross domestic product. Now, what exactly is our gross domestic product? Now, gross domestic product is how much we're producing, how much we're turning over, how much we're spending, all of those factors calculated into one, and it's showing how much the economy is growing. Now, if the economy is stagnant, as not growing or going backwards like we did in COVID, then technically we are in recession. Now, however, Australia may be in a recession or maybe have a recession coming up, but our prices in property and our migration is so strong, it actually might get us out of it. So you need to look at alternatives to investing to protect you through this period. So let's have a look. Here in the first opening line, if you're one of many Australians affected by higher interest rates and high inflation with income growth that's well short of the rising cost of living, you might feel that we're definitely in the midst of a widespread downturn in the economy. But do economists agree that Australia is in a recession? While there are no conclusive diagnosis criteria for determining when Australia's economy is in recession, they are guiding indicators. So let's have a look at those indicators, right? So a technical recession, we know that if a country's economy experiences weak or negative growth for 6 consecutive months, so 2 quarters, some economists will call it technically a recession. So in Australia, obviously in between 20 to 2021, during the COVID period, we had a massive drop. Then our economy picked up really sharply in 2021. We've seen this with people who sharply started to buy. Because our interest rate hit such a low point, people started to buy exponentially. They bought everything. Not only I'm talking about stocks, businesses, we're talking about properties in residential and commercial, basically took a spike and continued. Now, mid-2021, we had another dip, and then went back up again, and we've had on and off little spikes along the way. Now, the most important thing is that we look at a lot of factors. Firstly, we look at employment, we look at wage growth, we look at some of the manufacturers and retails, as well as consumer sentiments, right? Now, looking at it, where it says in this article, in Australia, prolonged decline in GDP combined with a substantial increase in unemployment is generally agreed to a signal as a recession, right? But we've gone through the peaks and the troughs, right? This occurs when a business cycle contracts from a peak of economic activity, high prices leading to less consumer demand and business trimming their staff levels. This definitely happened between 2022 to 2024. The first interest rate rises that happened to now, the 13 rate rises to now, have actually caused most people to halt their buying, trim back their home budgets, as well as making sure that they're not doing discretionary spending like holidays, clothes, buying excessive gifts, as well as just spending money on renovations or things that doesn't need to be spent on. So that has caused, in effect, a delay in retail spending and also in restaurants. And they in turn have cut staff, reduced shifts, not had any wage growth. So it's a cycle that goes round and round and round, right? So here we talk about some indicators. Firstly, a lot of people look at the US for indications. So the US recession indicators trigger significant stock market falls around the globe in early August. So if you were investing in stocks, you would have seen this. A spike in unemployment in July to 4.3% foreshadows recession according to the SAM rule. When unemployment has risen within a 3-month period by 0.5% above its prior 12-month low, then it's technically going to recession. So technically the US may not be in recession, right? The latest GDP growth in the UK aren't looking so good as well. And also, we've had New Zealand had a couple of dips into the recession pool. Now, where is Australia facing? It's important, right? Because while RBA still faces inflation that's too high, what we've seen in the US, you should now consider a cut in interest rate now risks much higher unemployment and inflation falling below targets. And the reason we say this, and this is from the head of investment strategy in ANZ, Shane Oliver, and the reason for that is in Australia, we've actually brought down our inflation over this last little bit. So our inflation, if we look at our revised figures as we go back to where we are now, so our inflation is holding at 3.8%. It's above the target of 2 to 3%, but it has come down significantly to where it used to be back in the day where we're getting 7% right after the COVID lockdowns, right? So we've actually almost halved our inflation rate. So it's coming down as well, right? And it's dampening our purchasing power as well, of course. But our saving to income ratio has fallen also, but of course that is to be because we're spending more money on our mortgages. So our quality of life is declining. Of course it has, because we're spending more money on our mortgages. There's more than 50% of the Australian population that actually have mortgages, which means that most people are stressed out by their mortgages, right? So let's have a look at the inflation impact. Labor cost growth, there's very little growth. It's actually now at 1.8% versus 2.3% in May. Retail prices haven't really grown. It's only grown by 1.5% compared to 1.6% in May. So all of this is Australia going into recession, right? And Dye and Durham Australian Market Pulse, in the same article released in April 2024, involved 1,500 people. They did a survey, found that more than half believe Australia will enter recession in the next year. But government and banking sector generally believe will avoid a recession. So which way is it, right? So the prediction 2024 really is that we don't have a strong rise in employment. We've only gone from 4.1 to 4.3. The GDP growth has 1.7 revised up from 1.7. So it's happening. Consumer price index of 3% is the aim, of revised from 3.8%. So we're getting there, right? So it looks like there's demand that's cooling, but the most important thing to consider is it's difficult to have a deep recession when our population is growing at 2%. Any recession at all, in fact, obviously implies per capita recession nastier than 2%. So what does this all mean for you as an investor? There's the debate, boom or bust, right? Whether we're going into recession. But at the end of the day, whether we have a recession or not, it really doesn't affect you, because ultimately what does affect you is your investment strategy. And this is more important than whether we have a recession or not. If you have a plan and a strategy forward or how you're going to invest in recession, you pick up some of the biggest deals out there and you pick up stuff. And what we're seeing right now in this market is that we're seeing developers having to let go of some of their prime stock. We're seeing investors who are either having a partnership separation or we have a divorce. They're letting go of some of the prime stock. We're seeing stock being sold under value. There is heaps of opportunities in a recession coming up. So instead of worrying about whether we're in a recession or not, you should just accumulate a war chest to move forward. And what is a war chest? Is where you put all your money in there, ready for when the opportunity comes. Now, when we look at property, the interesting thing is when we switch to property is that because we're such a growth in our migration of that 2%, we're about to hit 30 million people in Australia. Now, 30 million people means 600,000 people are coming to Australia a year, or having that population growth through either birth or people migrating, right? Migration takes up a huge percentage of that. So what does that mean for you? It means that all of a sudden there's the shortage of housing, shortage of commercial demands, shortage of these people who have services that they need. So it means as the urban sprawl is going to go further out, people are going to demand more accountants, more financial planners, more lawyers. They're going to demand more beauty therapists, more hairdressers, more dentists, more doctors, all of that stuff, as well as they're going to demand more housing. They're going to demand more schools, more hospitals, just all of those services these people are going to need, not just want, but need. And all of a sudden that creates a boom in the property market, regardless of residential or commercial. So if we look at a KPMG report, and this report was done in 20th of June 2024, it actually talks about how house prices to rise more gradually over the next 18 months. So house prices will rise nationally 5.3% over the next 6 months. This was in June of this year, which means now we're right in the middle of this rise of 5.3% and 5.6% during 2025. Now, KPMG's new property report on Australia per capita finds that apartments will go up by 5.6% in the following 12 months, in the next 12 months, right? The next 6 months, a considerable national variation will be Perth house prices rising by over 10%, Darwin and Hobart only experiencing 1.4% growth. For units, the predicted growth range in Perth is 8.6% to Canberra 5.3%. But in 2025, there'll be much greater house price growth consistent across the country. Melbourne prices will rise by mostly 6.5%, followed by Canberra at 6%. But even the lowest Brisbane will still rise by 5.1%, which means that no matter whether the economy is in boom or bust, property may still be the most reliable place to put your money to make sure it doesn't go down by inflation. Now, your biggest thing in property investment is to consider that the erosion of money. If your money gets put in the bank and the inflation's at 3% or 3.5%, it means that if you're buying a $1 million property today, if you saved or waited on the sidelines, you're paying $1,030,000 next year. Now, in fact, you'll be paying more than that, because the property should be worth $1,030,000, but because of the growth of the market and the demand of the immigration and the people, you're no longer going to pay $1,030,000 because of inflation. You're actually going to be paying $1,050,000 or $1,060,000, even $1.1 million, because there's so many people fighting for it and there's limited stock. So even though we might have a recession coming up, the most important thing is actually having your war chest and building out a strategy for investment. And still, property is by far, when we're looking at the reports from KPMG and other forward investors, property, even though we've had 13 consecutive rate rises, it continued to grow even slowly over that time. Yes, it didn't have the exponential growth that they had 20-30% within 1 year that they did between 2021 and 2023, but certainly each year compounding is still growing between 5 to 6%. So over a 10-year period, you are going to look at least 50%, if not more, on the investment you have. So it not only holds the value of money, but helps you to grow the value of money, which is really important for wealth accumulation, wealth creation, and ultimately financial freedom. So right now, if you have $200,000 or $300,000 or even $500,000, you need to park it into a property, whether it's residential or commercial. Watch my video on passive income, and that video is going to help you to define whether you want more passive income in your portfolio or you want more growth. But the most important thing is, how do you build out that plan to passive income? So if you had $200,000 or $300,000 right now, putting into property and putting into a property where the area is going to gentrify and change. When I say gentrify, it might go from an area that's lower socioeconomic to something that's now going to be middle class. That's going to create a change in terms of the value. You might be buying in at $500,000 or $600,000, but as the area change, it might be worth $800,000 in 3 years' time. So ultimately, the most important thing is to preserve the value of your money, because what happens in inflation periods and in recession is the value of money becomes lower. So the value of money diminishes, because let's face it, haven't you been to an Asian country where you are an instant millionaire? You basically withdraw $10,000 Australian and you're an instant millionaire there. Sometimes you can be a billionaire there. Have we not seen war-torn countries where their money is worth next to nothing? That's what happens when there is instability in an economy, when there is recession. The value of money diminishes. What you can buy bread for today isn't what you can buy bread for in the future. So ultimately, preservation of your money is the first level of protecting your money, and then the second level of growing your wealth. So at the moment, the securest ways to protect your money is to actually park your money into a property. And whether you park it in residential property or commercial property depends if you want passive income or not. If you want passive income, then commercial property is the way to go. If you're chasing more growth and that you can service the debt and you can afford to be negative, then you need to go to residential. So either one have its benefits. Watch my video on passive income, and that will share with you whether you should go residential or commercial. But most importantly, the next steps for you is to actually go and find a property to put your money in because you don't want it to be eroded away by inflation, or if likelihood there is going to be a recession. Now, if that's worthwhile to you and you want some help in your investment journey, please click the link below, book in a free strategy call, find out a way to join our community. And if you like this video, make sure you leave us a comment below to help me find more interesting topics to talk about. In the meantime, make sure you do subscribe, spread the word, and I'll see you in the next video.